Good evening, everybody. My name is Michael DeJoyer. I'm the founder of the Affinity Trading Institute. I join you here from my personal trading desk here at the Affinity Trading headquarters. And I just want to, was down on the floor of the New York Stock Exchange today. And there is my badge from my visit today. And any of you who decide to join us on this program can certainly come and journey down to the floor of the New York Stock Exchange on one of our future visits. I was meeting with our floor broker today, and the stock that I played this morning is a stock that probably, um, one of my floor trader friends is the specialist of. The stock that I traded was KSS, and I'm going to keep referring back to this stock because I like to give current real-time examples of stocks that we played. And what I'm showing you right here, and I want you to, take a look at this daily chart. Here is a stock. This is a prime example of a stock that, that we would play on an intraday basis. Here is a stock that's down. The trend is down. We have declining moving averages. And recently it goes up for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 into a double top area. Okay? So it's got a high, a failure to make a new high, but a green bar. And then guess what? Bammo, right? It has bad earnings. And it gaps down. Okay? And believe it or not, our first mention today was a minor fade play. I'm just going to stretch this out and show you a little example of one of our trading plays. We call this the reverse check mark. This is the kind of play that I specialize in teaching our traders, people who trade with on our corporate account. We have a 5-minute high break, a pattern that's called a 1, 2, 3 continuation play. And I'm just going to zoom in and then go sideways, and then zoom in some more, and then go sideways. And the first bar is green. The second bar is red. It breaks a little mini double top here, okay? And then obviously it hits the target, takes out the target. And then after that, it fizzles out and dies. And guys, there is a way to know when it's fizzling out and dying because we actually went long this. And then, because this was initially called as a possible fade, but then turns into, what we call the reverse check mark play. And the reverse check mark play is it goes up and then down. And I'm just going to draw this on the whiteboard for you. A check mark looks like this. Well, the reverse check mark looks like this. Okay? So what happens is as the moving averages come down, okay, it gets near the moving averages and then starts to trend down again. So here we had this play as a fade. And then obviously afterwards, it made a movement down. Now, guys, I certainly did not kill it on this play. I had to go to the New York Stock Exchange, and I had a lot going on today. And actually, I did make one bad trade, which obviously ended up working. But, not the end of the world. And I'm just going to bring up these trades. I did make another trade, so I'm just going to show you some of the trading results from the day. Okay. So here are some of the trades for the day. Okay. Made a little bit of money on Facebook, made some money on KSS, lost some money on KSS, made more than enough on KSS, ended up getting out. Okay. And then sure enough, the other one that I made a lot of money on was TTWO. Which was a gap fade. So here's a stock that gaps up. Okay, I'm going to zoom in on this one. This one that's gapping up into resistance and then fading down. Okay. And it wasn't, wasn't a huge day, but I'm just going to snap this on there. $509.48. Okay, and I believe the last trade was done around 10:30 or so. So not a bad day, $500 or so in about an hour, about an hour's time, maybe about 15, 20 minutes worth of intraday study or pre-market study. Um, so a good start. Got up, went to the New York Stock Exchange, helped my students a bit. Some of the guys really did pretty well. Here's one of the students who made a great trade, another trade that we'd call on NUGT, which is a gold company, NUGT. Okay, so here is the daily chart. It gapped up. This one we would call it a gap and go. Okay, because it gaps up, breaks the 5-minute high, and then goes. And then you try to run it as far as possible. And I'm really impressed with this because this gentleman knew enough. He took our class back in, I believe, in September, just the gap class, not the full program, just the gap class, and took the trading evaluation professional program that we're talking about tonight. And he took one trade. Okay? He marketed in, he updated his stop, he pieced out his position, he ran the trade for as long as he possibly could, canceled a bunch of orders as he updated his stop, and then eventually got out for a nice $188 gain on one gap and go. Okay? So another one of our students doing pretty well with some of the information that we taught him. Okay? So that's another example of a trading tactic that we teach here in our program. Now let me talk to you a little bit about the program itself, and I'm going to shut off the video cam here so that we can have a little more screen space. So bye. Okay. So what I'm going to do is I'm going to bring up our slides here, and guys, this would not be a trading seminar without a disclaimer. The purpose of our presentation here is to see if you're a good candidate for one of our trading programs. Okay? And our education and our programs are designed to teach you how to trade. It is our opinion that someone cannot properly learn how to trade, or it is much more difficult for somebody, not cannot, but it is much more difficult for somebody to learn how to trade properly if they don't actually get to trade. Guys, isn't that shocking? Okay? That means that in order for you to learn how to trade properly, you should actually be trading. And Michael Parness and I are putting our money where our mouth is in that we have a funded corporate account that we are willing to let you trade if you are willing to let us teach you. Now, that does require you to buy our program. Okay? So you do have to make a purchase in order to get to trade our account. Okay? But we are looking for people to trade our account, our corporate account, so that you can apply our techniques. And I'm going to give you a great example of that. Here, my buddy Larry took a trade that I missed. Larry took a breakout on a 5-minute high and traded it like a champ. Okay? Traded it like a champ. Okay? So just a case in point, okay, part of the reason why we're doing this is we want to teach our students to apply our techniques to things that we might not be looking at ourselves. All right? So that is a very big incentive for us and obviously for you because it also allows you to trade when you might not be in the position to do so. Okay? Without our help and assistance and obviously some of our expertise. Now, let's continue on this journey. I just want to spend a little extra time on this disclaimer. I don't want us to gloss over it. Guys, you should not be trading if you do not have discretionary capital to either pay for your education or to open a trading account. Trading is best done from a position of strength, meaning money that you are not necessarily afraid to lose. Okay, because trading involves risk and there's always the potentiality for losses. There's always the potential for generating a loss. Myself and Michael, we are very good professional traders, but we certainly lose money. I've lost money, recorded it, and put it on YouTube. So because we're able to lose money, because we lose money, okay, that means that you can lose money. Okay, trading involves risk. Now we do risk manage it. We do apply a set of risk rules to try to help you lose less money. Okay, but trading invariably involves risk, and it's something that's not suitable for everyone. Okay, a little bit about me. I've been trading for 17 years now. I have a number of security licenses. I am a licensed broker. I am registered with a firm in New York, Rothschild Lieberman. You can look me up on FINRA Broker Check. I am, in fact, a customer of Rothschild Lieberman with one of my corporations, as well as I am actually the broker on the account. Okay? I have been a trader, a risk manager, and a market maker. Okay? I have my market maker's license. That's the Series 55. I believe that the only way that we can compete with the big professional trading firms is for us to trade in a team environment. And in doing that, we have to supplement each other and help each other find the best trading opportunities each and every day. And that's kind of what we do in this program. And the idea is to try to help one another do something better than we would do on our own. Luis is in our room. And I think Luis would be definitely somebody who would state that he has benefited from our expertise. And I know there's a couple of other people in here too, John S. That certainly has seen our ability to support one another and look out and find good trading opportunities to share with the group so that we can all profit. I'm going to talk a little bit about our training. Okay, I'm going to talk a little bit about breakouts, breakdowns, gap trading. Michael's going to share with you some of his techniques and his trading techniques for trading in a volatile and somewhat bearish market. But before we get to that, I'm going to talk about professional trading for a living and the Affinity Professional Trader Program. Okay? I believe that what we have strived to do is create the most comprehensive, most hands-on trading package that I know of. Let me talk a little bit about our training. Guys, first off, I just have to cover a couple of things, okay? You get a 2-day foundational, okay? 2-day foundational class. That's 2 days of solid trading education. A 2-day advanced class. But guys, I want you to notice that I'm only pointing to this little sliver of the pie. You get a 5-day live trading lab. You go into our online trading room and trade with us live, okay, for a period of time, 3, 6, 9 months, a year. You get the assistance of our professional risk management, our automated risk management systems. And then, of course, you get the ability to trade our corporate account, which is our trading capital. And last but not least, you get our coaching. Okay? So that comprehensive program is what it takes to make, in our opinion, a successful trader. Now, guys, the reality is that most people who endeavor to trade lose money. Okay? And we cannot change that. It is still a 50-50 coin toss, even if you take our program, risk our money in our corporate account. Okay? It does not guarantee you any success as a trader. It just increases your odds. Okay? Whereas maybe most people, 90% of people fail, maybe now you're 50-50. The one thing we do, okay? The one thing we can say is that at least we know the tactics that we teach make sense. Okay? And that we know that they work. Because we do them ourselves and we're risking our money, okay, to apply them to the market. Now, guys, if you don't follow the rules, that won't change a thing. Okay? You got to follow the rules for the systems to work. Now, what styles of trading do we teach? We really heavily focus on relative strength trading. The objective of relative strength trading is carrying a position while hedging, adding and taking profits depending on that particular stock's strength to the market. Now, guys, I have to show you something. This is from this morning. This is a real example. This is the market this morning, and I'm just going to bring this up on a 5-minute basis. Okay, guys, this was the market this morning. This was the market this morning. Okay, this was TTWO. The market opened up down, went down a little bit, and then rallied. TTWO, okay, Take-Two Interactive, gapped up. When the market was going up, it didn't go up. When the market was going down, it really went down. Okay? That's a prime example of relative weakness. Okay? A prime example of relative weakness, okay, in a market, okay, and a stock that we selected for a specific purpose. Now, the best analogy that I can give somebody about relative weakness and relative strength as a trading style is, you pick the weeds, you water the flowers. Okay? At the first trade I took on TTWO, first trade we took on TTWO, we weren't sure. It ripped up a little bit, kind of got out. Then we saw that it was relatively weak to the market. And then it turned out to be one of the best trades of the day. Bang, fast move, drop down, gap fade, almost gap fill, and then we were done with it. All that time, the market was just chopping about, but it was relatively weak. When it moved down more than the market. When the market moved down, okay, TTWO moved down a lot more. Valid style of trading. Directional day trading. You're looking for low risk, high odds technical trades to achieve your daily target. Now, at the Affinity Trading Institute, we've been teaching this for almost 10, actually for 10 years. Setup, trend, pattern, trigger, stop, target, timing in between. Gap trading and fading is my favorite style of trading. It's my specialty. Okay, you look to capture gaps and gap fades, gap and goes. Already mentioned one great gap and go was the GDX and the Nugget. I call it NUGT. Okay, that was on some gold stocks. We also teach scalping and some rebating. Okay, which explains the visit to the floor, right? And that style of trading, it's patience, efficiency, discipline. We teach all kinds of routing as well, because that's very important in trading. You save cents, makes dollars. What do? We help you create a smart plan. Create a trading plan of your own conception, okay? We teach you the foundational seminar, the online trading lab, trading theory and practice, okay? At the end, you even get a certification. Okay, we teach you to trade on very small money initially. Okay, we don't do these percentage payout levels, so let's just cancel that. Okay, we actually give 100% payout up until you get the class fully refunded to you. Okay, so it's 100% payout until you get repaid the amount that you paid for the program. Okay, that's why these are no longer valid. Now, guys, initially we give you very small money. We let you trade 1, 5, 10 shares, 15 shares. Okay, it doesn't matter the share size because we want to teach you the concept of trading correctly. Okay, we want you to risk a small amount per trade and try to hit your daily target, your weekly target. Okay, your daily target, your weekly target. Daily target, your weekly target. Okay? Without losing your maximum risk per day. If you lose your maximum risk per day, that's fine. Just don't lose your maximum risk per week. Okay? Stay within those risk parameters and you show discipline. And guys, we'll let you start all the way down to level 6, depending on what program you sign up for. That means that you could risk up to $150, up to $450, okay? Up to $1,350 per week. Now, what is the one no-no? Okay? Losing your maximum risk per week or hitting your weekly target and then going negative. Okay? Because we really want you to apply the 30% rule, which is when you hit your daily or weekly targets, that you keep at least 70% of that target and stop trading. Okay? So we really want you to focus on showing discipline and risk management. Okay? And there you go. Trader receives 100% payout until tuition education cost is fully recouped. Okay? And that's at the professional trader level. Now, guys, you need to be gross realized green. You need to be gross realized green in order to be successful at trading. And this is just the trading runs of one of our traders, who is gross realized green. That means you got to pull money out of the market. That means that your screen at the end of the day needs to be green. That means you pulled money out of the market. You guys need to be green. You see that? Close P&L. Green, 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 green. Does everybody see that? Shares trade. Some traded a lot of shares. Some didn't trade many shares at all. So we got students from the very beginning level to the advanced level here. Okay? And guys, by the way, we're one of the few places that offer the most sophisticated trading software out there. I don't know how many of you have ever seen this one. This is Tachyon. Okay? This is one of the most sophisticated trading softwares out there. Okay? So this is Tachyon. And we're one of the few places that offer it. So if you are interested and you know what Tachyon is, you certainly want to start consider trading with us, because we are one of the few places that offer Tachyon as a trading platform option. Okay? So guys, the key to making money is not losing too much. Net profits are made when gross realized gains pay trading fees, software costs. The road to profits is paved by small but consistent gains and manageable losses. Okay? So guys, you really need to focus on making bite-sized gains, but consistently. And that's what we try to teach you, is how to consistently make money in the market. Okay?
Yes,
While we wait,
John.
does anybody have any charts that they... Go ahead,
Yes.
Michael.
Hey, yes, John, that's exactly right. Listen, if I wanted to learn how to play basketball and I had the opportunity to have Michael Jordan teach me, that's exactly what I would do. If you want to learn from somebody, learn from people who are successful doing it.
Anybody have any charts they'd like me to take a look at? Any stocks that they'd want me to do some analysis on while we're waiting for the slides to load?
Yeah, Netflix.
All right, guys. So right now on the daily chart of Netflix, we are at basically a key support level. You notice there was this kind of a support level that was put back in the August correction. Netflix pretty much fell off a cliff, gapped down, faded up. It was there for one day, but we're kind of at that key support level. Now, usually what happens, this is a pattern that I call the N-shaped top. Okay, usually what happens is you have a curl, a high, a failure to make a new high, a steep drop, a V-pivot, a choppy move up that leads a return to a move back down to that key support level. What usually happens is that bear flag pattern that I was actually telling you about the other day in the room, Michael, is that you get a move, okay, down, and usually moves get steeper as they get lower. And then what happens is that they kind of make a choppy move up. Sometimes they go a little higher, sometimes less, and then they make a drop down, usually to the prior level of support. That's not, that's actually, that was take two. Sorry about that. This is the Netflix daily chart. I think that's just a little bit of lag. I think there's a problem with the projector. Hold on one second.
It's labeled TTWO, but it's not TTWO. It's Netflix.
Yeah, it's just it was a lag. It got like stuck data for the projector there. That's all. So guys, this is Netflix's chart. It's just the label was lagged. All right, guys. So you got the curl, the drop, the choppy move up, the move down, and then you get to the bear flag. And then what usually happens is you make a little mini bear flag here, and then you get another move down. Now, guys, sometimes they do go back up, but that's usually because it goes the direction. The first direction is usually the continuation direction. Now, and we are trend traders that we trade the prevailing trend, the direction that's most likely to work.
You ready, Mike?
Um, yeah, I'm just waiting for the slide. It says 3 of 13, 4 of 13. We're just about ready.
Tim, I hold stuff overnight at times. Depends, obviously, on the trade. Some stuff is day trade. Mike calls a lot of scalps. I call more swing trades.
Usually, what I like to say, Tim, is that I scalp for cents. Okay, I trade stock for cents, options for dollars. So I would prefer to swing trade using calls and puts as opposed to trading stock. I like trading stock because you can get in and out, very nimbly and very fast using some of the direct access software. All right, guys, we're ready. The slide's just loaded. All right, there you go, Michael. The floor is yours.
Okay. Um, okay. So class is called Bear Market Profits. Disclaimer, trading involves high risk. People can and do lose money. Please know your risk tolerance and don't trade with money you can't afford to lose. I'm not registered or licensed. Mike is. All info is reliable to the best of our knowledge, but we cannot guarantee its accuracy, so please check on your time and do your own research. Past results are not necessarily indicative of future performance. Plan your trade and trade your plan. Okay, so a bear market is defined as a market that has dropped at least 20% off all-time highs. A bear market can take place in any stock, index, commodities, currency, etc. Bear markets follow some patterns, trends that we can take advantage of for potentially huge profits. Protecting your investments and capital preservation are keys to dealing with bear markets. Blindly following the notion that markets always end up higher is not only dangerous, but an irrationally silly concept. Markets go up until they don't. Stocks go up until they don't. The markets, meaning the S&P, Dow, NASDAQ, Russell, the indexes, are rigged to move higher. It's easier to give examples on individual stocks over long stretches of time, i.e., look at charts of Intel, Cisco, Hewlett Packard, even Alcoa. Underperforming stocks either get dropped from indexes or a more durable, stronger stock is added to help prop indexes up over time. So just because the market's made all-time highs not so long ago doesn't mean that anybody who owned individual stocks did fine. Obviously, if you own Cisco and you're a long-time holder of Cisco, you've been suffering for a long time, and the stock is roughly two-thirds off its all-time highs. So it's down about 67% or so. Not what my idea of a good investment is, right? Bear market. NASDAQ. High on the NASDAQ, all-time high was not so long ago at 5218.85 on 7/2015. Now it's actually 4,500 as of the close today. It needs to fall to 4175.08 to be officially in a bear market. The Dow, its all-time high, 18,351. On 5/2015 now, it's actually 16,400 because we rallied off when I first did this. Needs to fall to 14,680.80. It's obviously over, well, now it's about 1,700 points. Gold was 1895 in 2011. Now it's $1,100. Clearly, that's in a bear market. Oil was 147.15 in 2008. Now it's roughly 30 bucks, 31 bucks. Soybeans were 17.90 in July 2012. Now they're 8.60. Apple was 134.54 last year. I believe late 2014 actually. Now it's 96s. It's in a bear market, right? So while the indexes are not yet in a bear market, and perhaps they'll never get there, uh, clearly there are stocks, commodities, um, precious metals that are in and have been in a long bear trend. Okay, so protecting investments. There are many ways to hedge investments. These are just some. You can sell call options against your positions and keep rolling it over, collecting premiums until the market seems bullish or until the stock prices fall into a point where you feel you want to buy some more. Okay? You can use index futures or stock futures to short versus your stock or index ownership. Okay, so if you're an investor, but you feel like, you know what, we're kind of in dangerous times, there are ways to hedge your positions. You can buy puts to give yourself a modicum of protection against a really big disaster. One of the things I like to do if I'm investing in a stock, um, a volatile stock in particular, is I want to buy some downside puts, maybe, fairly substantially at times out of the money, just in case there's some kind of disaster and, my stock craters. So you can do that. It doesn't give you all the protection in the world, but it does protect you against disaster. You can do pairs trades, shorting one stock versus owning the stock you own, though that's a lot riskier. So for example, you could have gone, last year we had a pairs trade, own Facebook, short LinkedIn. Today that paid off pretty well since LinkedIn was down some $50 after hours or something. Bear market profits. From March 2008 through early 2009, I turned under 20K into roughly 3.8 million. Here's how I did it. First of all, I was ultra bearish and simply said every time the market staged any rally at all, I kept adding to my shorts. In fact, I wanted the market to rally so I could keep adding, committed to the notion that the market would crash and burn. It did, thus I made a nice big fat payday. If I were wrong, I would have lost what I started with. There was always risk you were wrong. There's little you can do to not lose if you're way off on your call, right? You make a bad call, you make a bad investment. There's not much you can do. You're going to lose money. Nobody can teach you how not to lose money if you're just way off. God bless. Bear market profits, current call. Right now, the S&P is actually, again, this is higher. It's 1912. Um, Today we had a pitiful rally. My downside target is, believe it or not, 1250 on the S&P. I think the chances of us not going into bear market territory are literally less than 20%. You need to buy 1/3 to 1/2 size positions to give yourself a chance to add. Don't make the mistake of shorting or buying puts and not being able to add. That is the key to the ability to pile up a large gain. So one of the things we look at, and I'll talk more about it in a minute, is relative weakness and relative strength. I just talked about Apple, right? So I'm very bearish on Apple. Since I did this class last week, the market has rallied about 50 S&P points. That's a substantial rally. That's about 3% or so, right? Apple hasn't moved a single penny. So the market's moved up 3%. Apple has not moved up at all, showing relative weakness. What's moved up? Facebook, relative strength, right? So if you think we're going to rally, you want to be in Facebook. If you think we're going to sell off, you want to be in Apple. Short. Okay. Um, don't make the mistake of shorting or buying puts and not being able to add. That is the key to the ability to pile up a large gain. So, what I try to do is I try to take a position, a small position, and then add to it if I'm wrong, depending on the type of trade. If it's a day trade, I just stop out. But if it's something I'm committed to, um, such as I'm committed to, um, you know, Apple short. Okay, so if Apple were to go to 100, I would want to add to my puts. If Apple would then go to 105, I want to add my last third. I'll talk about that trade in a minute. I want to give myself a chance to add so I don't get blown out. And then I stop out if I'm wrong and Apple then busts out and, where it somehow go to, 110 or something like that, I would be out of the trade and, you know, lick my chops and move on. Set manageable targets, but let your winners run. It's key. It's key. I talked to one of our traders today in the chat room, and she said that she has a tendency, she lets her losers run, and she takes profits too soon. Well, there's a saying, don't eat like a squirrel and poop like an elephant, right? You got it? So you can't, you're going to lose your money if that's your strategy. If you're taking 30-cent profits and you're losing a buck 30 on your losers, you'd have to hit like 75% just to break even. Well, not that many people hit 75%, and you'd have to hit more than that to actually make money. So not a good strategy. So if you have a swing trade or even a scalp, you might want to let a little piece of it. So if I were to, for example, leg into a position and I filled my full position and it starts to move my way, I'm not just going to take profits the second it goes, 2 cents in my direction. I want to give myself a chance to have a, pretty big winner. If you're scalping small gains because you don't hold overnight, that's different. Again, this is for swing trading only. Okay, so here's a trade example that I've given. It's Apple, 96.30, set targets, 85, 75 potential for move back to 2011 lows at $44. Okay, seems crazy, but if we do go into a full-blown bear market, trust me, it won't seem so crazy anymore. Right? Plan, buy XYZ puts at X, a third share lot, add a third if Apple moves to 100, add another third, like I said, if Apple moves to 105. Potential risk equals the full amount. Exit plan, if I fill full size, right? If Apple were to move to 105, I'd sell a third on a move back down to 96.30. I'd sell a third at 85, and I'd ride the last third for as low as it goes, trailing stops with a stop out at 92 on that last piece. That's how I have made a lot of money in the past. Okay, if you never fill the third, use the same format, selling the second third on a move to 92 and riding the first third same way as above plan. So just trail it as it goes. And hell, if I'm crazy, right? But if I'm right and Apple somehow gets to $44, you'll make a fortune. If you never fill anything but the first third because stock goes your way, just ride that position as far as it can go for you. Take half off at a double, right? So if your option price doubles, you can ride the rest for free. Okay? Set a stop on the second piece, but you can ride it for free if you get a 100% winner on the first half. All right, here's a bear market profits bonus play. Netflix closed today at 89.71. Netflix is a killer company, no doubt. In this market, it's also the kind of company that is getting cracked on an almost daily basis. My longer term target on Netflix is 30s. I think 75 is next stop on that trip down. It's always possible the market reverses, right? Or someone buys them out. But even when we've bounced, Netflix has gone down. Okay? Netflix has gone down even when we've had rallies lately. Relative weakness is a key way to trade a bearish market. These are the stocks we want to feed on. So the play here is to short Netflix with a stop at 103.79, okay, which is a very wide stop. I take half off at 75, trail stops with a $7 stop from there. That's if you want to short the stock. The option plays I like are the $90 April puts at 8.30, which is a straight play, okay, if you can't play spreads. If you can play spreads, I like the April $90 puts at 8.30, you buy them, and you sell the April 85 puts at 6.10, is a total debit bear spread of $2.20. Your potential payoff is $5 or roughly 125% profit. If you did that, I'd roll the play over 3 months out again in April, hopefully at lower prices. So use $5 in the money puts. At that point, hopefully Netflix is the gift that keeps giving. Now, some of you know I've been very bearish of a stock like Deutsche Bank for a long time, since it was well over 20 bucks, and we just keep on rolling it down. Just keep on riding it down, riding it down, riding it down. Now, at some point, it'll hit a bottom. Okay, so you know what? It'll reverse and it'll stop me out. I've already taken some profits, some really nice profits. Index trade. If you make the assumption I do that the Dow, S&P, Nasdaq all trade into bear market territory, at least, then you can trade that. S&P, Nasdaq all trade into bear market territory, at least, then you can trade that using several means. You can use the futures. I do that all the time. It's the cleanest way to trade. Simply short contracts using the same methodology as the Apple example. You can do it with stock. You can short the SPY, QQQ, DIA, Or if you have more risk tolerance, you can use a 3 times ETF like TQQQ, SPXL, etc. Again, use the same method as with Apple, right? A third, a third, a third. Puts, play in the money puts on indexes, adding. Higher strike prices by thirds if it goes against you and exiting like Apple example again. So in other words, if you were, for example, in the Apple $95 puts and Apple moves to 100, I would then add a third at 100, the $100 puts. Okay, then Apple moves to 105, I would use another third, the 105 puts. Okay, because it kind of gets silly if you're, using the same puts. Tendencies of a bear market. In a bear market trading environment, we have several tendencies we can look to as predictors of price action. Short gap ups. Again, another day where today we were early on up 149 points. My God, it's like free money raining down on us. Where were we going? Yes, last Friday we went up 400 points, right? Whoop-de-doo. Okay, we have stops that aren't going to allow us to lose 400 points. But if you've shorted the open, all of these gap ups, they've all rolled over. Every single one. Every single one. Even when we went up 400 points, we had first faded. Every single gap up in this bear market that I think we're going into has been a short. Every single one. You come into our trading room, you join Mike and I, fading that gap. We call it every single day. It's like clockwork. It's like clockwork. Tomorrow we have, big numbers coming out, right? We have the ISM. What is it? No, not the ISM. I'm sorry. The employment numbers. My God, if we gap up, it is such a short. Because in this market lately, and again, if we're wrong, and this is the thing you have to remember, okay, as a trader, as an investor, whatever it is, yes, there's going to be the time you come into the chat room tomorrow, God forbid, tomorrow is the day we gap up 200 points and then we go up 500 points. Okay, you're going to lose on that trade. But chances are we're going to call a continuation pattern and be able to play it from the long side. We're going to reverse. That's your edge as a trader. Don't give that up. Right? That's why you don't get caught in a trade foolishly and sit there and watch yourself get beat up and 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 go, oh my God, it has to go down or it has to go up at some point. There's no point in doing that. We've all done it. Trust me. I've done it. Mike's done it. We all have outstayed our welcome on several trades, on trades over the years. Trust me, many. But we try not to make a habit of these things, right? We try to break these habits so that we don't keep on pounding our head against the wall. It's not how we're going to make money in the long run. How we're going to make money in the long run is by sticking to the plan, using stops, using proper money management techniques, which we teach you. Okay? Gap ups rarely hold up here. In fact, the bigger the gap up, the better the short is. Fools rush in at every turn thinking the market is ready to bounce. Maybe it is. Okay, we've bounced 50 S&P points. Okay, 50 S&P points. The problem is if you don't own the freaking, these little, Alcoa and those little uh, Freeport McMoran and all these little ones that were so beat up, you're not making money anyways. Look at today. Google was down. Google was down, had blowout numbers and is down 100 You know, everybody's out there. Kramer's pounding the table every day. Google, Google, Google. It's down $100 off its earnings. $100. Hello, hello. Relative strength, relative weakness. Rallies initially trend to start late day if they're going to occur. That's because even on what appear to be really bullish days, well, today wasn't, a great bullish day, but, we were up early, we went red, and then we went up again into the close. Suckers get fooled, rush in, and then the market tanks. Smart traders like us wait for late day for confirmation of a breakout and don't worry about being the first one in the pool while the turd is still there. Stocks that enter bear markets for themselves become easy marks for us to short on bounces. The weakest stocks are the ones we want to pick on. If a stock is making new highs in this market, we want to avoid it as a short. I don't want to pick on Facebook. Mike called Facebook today for an intraday trade. I get that, right? But Mike's not buying puts on Facebook. It's not, I don't want to pick on Facebook. I'll pick on Amazon. I'll pick on Tesla. I'll pick on Buffalo Wild Wings. I'll pick on Netflix. I'll pick on LinkedIn. I don't want to mess with Facebook. Facebook has held up the best out of any of these stocks. So why do I want to short Facebook? Like was long Facebook, right? So um, let's fight the elementary kids and beat them up, not the high school wrestling team. Okay? You know, I'm too old. I'm not fighting anybody. But if I was going to have a fight, maybe a sixth grader would, throw a punch at me. I'd duck and I'd nail him or something. I mean, I'm not going to go fight a high school kid because he's going to kick my ass. I'm too old. In my day, I would have kicked his butt, but I'm way too old now. Rallies in a bear market are often the kind that rip your face off if you're caught short, right? We saw last Friday when we went up 400 points. So use stops and don't worry that you missed the move. Like I said, I made much of my money in 2008, 2009 by pressing my bets after rip your face off rallies. These rallies can be great money makers for us long, or ways to add to positions or start new ones. Right after that 400-point rally, what did we do? What did the market do? What did it do? Anybody want to take a guess? Anybody? That's right. We gave it all back and then some. What idiots were rushing in? I mean, I'm sorry. But you that's not the time to buy. You want to buy, on a really washout day like we had yesterday where we reversed 400 points intraday. I get that. You want to take a stab there, but why are you buying at a 400 point at the top of a 400-point rally? Yeah, maybe we have a continuation. Maybe we go to 2,000 on the S&P. Hell, maybe we go to new all-time highs. But let the market prove that to us. I always say when you're going with the trend, and the trend is clearly down, no matter how you look at the market. Again, doesn't mean we won't rally in the second half of the year, although I don't see it. Doesn't mean we won't go to new all-time highs, although I don't see it. But let the market show that to us. Let it prove it. You know, if you are going against the trend, you could be wrong 1,000 times. If you were going with the trend, you'll be wrong once. Because when the trend changes, you know what? You're going to change with it. You're going to stop out and you're going to go the other way. I was short on the day we were up 400 points. I lost money on the trade, had my face ripped off, and then I reversed and I went long and I made money. Okay, I can live. Even if I didn't make money, I'll live. I promise you. I'm not going to die. I'm not. Okay? The only time you really, you get hurt, Mike?
Yeah, go ahead.
Oh, I thought you were saying something. The
I
only,
was gonna,
the
but
only,
you could finish.
yeah, the only time you really get hurt is when you're so stubborn that you don't pay attention to the signals the market's giving you, right? When you don't, when you're so stubborn that you just are like, no, I'm right, I'm right, I'm right. Now I am making all these bold downward calls, but you know what? If I'm wrong, I still think I'll make money this year. I still do. Maybe not. Maybe maybe I'll get stubborn like an idiot. I've done it in the past, but hopefully I won't, and I'll just admit I'm wrong and reverse. Mike, where's the slideshow? Where'd it go?
Michael, just 1 second. I wanted to say something real quick. Guys, every day I make a whiteboard, and I do it because this is what I started. When I started on a trading desk, it was like we were in an actual physical office, and we marked up the whiteboard, and all of our trading ideas were put on the board. And we had black is for Monday, blue is for Tuesday, this kind of fuchsia color or violet color is for Wednesday, and the other color is for Thursday, and then we just go on down the list. Guys, we do this every day, every week. Okay, and this was a Friday where I thought we'd gap up and then pull in and then do the check mark play. Okay, and then here's this is another week. So we just go through and we give all of our ideas. We go through stocks that are gapping up, stocks that are gapping down. Okay, some day trading ideas. Okay, and then we just keep on going. So I give ideas for where we are on the prior day, and I kind of give direction, and that direction is protection in case things don't happen the way that you plan them to happen. So you have kind of like if then statements. If the market goes up, then you do that. If the market goes down, then you do that. Do that. If it's a Wednesday, look for oil number action at 10:30. If it's a Thursday, look for natural gas number at 10:30. We got FOMC. Michael's a great FOMC trader. I generally, in the past, would stay out of the way of the FOMC. Um, and then by the way, I also go over the plays for the day with the traders, and then I do some live coaching with the guys that are on our corporate account to see who traded well, who could have done this better, who could have done that better. Um, and what you will see is you'll see a lot of green marked up because a lot of times, I'll go over the ones that are working particularly well. Um, today you could say one trade, KSS, which was a gap fade and then a gap and go down. And we mentioned it because it had shock, which is one thing I started the presentation with. And we also talked about Facebook a couple of times because of it being a blue sky breakout on the long side. So you guys get the gist. We give a lot of clear guidance and direction. The other thing that we do is we actually post our trade ideas in the room. So here you got Michael putting in his idea, his trade on the Qs on Buffalo Wild Wings. Me talking about KSS as a gap and go down and a fade. It was a gap and go down. We called it as a gap and go down after the small initial fade. And the TTWO, which was actually a gap and go up, but it turned into a fade. And that's where the real-time guidance comes in because sometimes the initial plan changes. And that's what Michael was just saying about staying flexible. All right, guys, I'll let Michael go to the slide again. Sorry about that, Michael.
It's okay. It's good information. Okay. Um, right. Psychology of a bear market. Trading a trending bear market is not easy. Let's be frank and open about it. It's not for the faint of heart. It's easy for most people to imagine Apple going to $250 who love it. It's hard for most to imagine it can see my call of $45, $44, which is the 2011 lows, right? Most people would snicker if I said Apple's going to 44 bucks. They're going to laugh at me and call me an idiot. Okay. But if I said, I think Apple's going to double, I think Apple's going to triple, I think in 5 years, Apple's going to be $500 a share from 96. Most people are not going to like berate me for that call. They're going to be like, yeah, I could see that. Oh, yeah, no, ooh, yeah, you know. So it's not easy to kind of have the wherewithal to stay with a short call. Um, you can't get caught up thinking you were too late to the party. At some point you will be, but we haven't even entered a bear market on the indexes yet. If we are wrong, so be it, then we lose. But if you use proper money management, you'll be okay. That's the key always, money management. If you are risking 30% of your portfolio on a given trade, then you better be right. When I say a third, a third, a third, I'm typically talking about 1%, 1%, 1%. Maybe 2%, 2%, 2% if it's a sole position. Also, keep in mind, to make a crazy sum is possible, clearly, I did it, but it's not probable, okay? And in order to do so, you better follow specific rules and not go nuts on any one trade. Think about it this way. Let's say you put on a trade on Apple using my game plan. Let's say you risk 2%, 2%, 2%. You would make a boatload of money potentially if you followed my game plan and if Apple goes to $44. I mean, do the math. The potential is tremendous. But you have to be willing to stick to your plan and not deviate, and you have to be willing to do so with money you can afford to lose so you don't allow your nerves to fray every time it appears it might not go your way. If you can't do that, don't even bother putting the trade on, folks. You'll just as likely screw yourself and lose all your money. Thing is, as with all trading, you certainly can lose and be wrong. We aren't always right. Hell, maybe the market will go to new all-time highs in a month or two. If that happens, I'm pretty sure I'll lose on my swing trades. Sucks, but no risk, no reward equals no profits. Well, you trade with your head, not over it. Any questions? I know, Judy, you had a question about how do you know what time frame? So this is a great question. And it's also the hardest question to answer when it comes to options, right? Because it's easy for me to say, pick a target. Okay, I think Netflix is going to 75. Okay. Now, how do I play it with options? It's easy. You have a $10 million account. You play the stock. You short a couple thousand shares. You set a stop on it. Okay, the most I can lose is, 2,000 shares is $28,000 because I have a $14 stop. I'm going to take half off at 75 plus $15. Okay, I have my one-to-one risk reward, and I think it could get down to 30s. So then I'm going to take my last 1,000 shares, and I'm just going to ride it, right? That's easy. With options, it is tricky because, I think Apple's going to 44. Okay, crazy, yes, I'm crazy, yada yada. But you know, it's not going there tomorrow. It's not going there, next week. It's not going there next month. It may not get there this year. It may take another year. I don't know. It may never get there, obviously. So, you know, what I try to do and how I kind of phrase it, first of all, you should sign up for my Extreme Options Trader Service, Judy, if you're not a member, because I give you those trades and the entries and the exits and whatnot. But if you're doing it on your own, what I suggest is you use your technicals, okay, and you pick a spot and um, you take the trade. I like to play in the money puts for if you're playing like 1 month, 2 month, even 3 months. I like to play in the money. This way, I'm basically saying, I think the direction of this stock is down. I think it's going to go more than what, the premium that I'm paying. Okay. If I go out of the money, I can be right and I could lose my money. That's my problem. I don't want to be right and lose my money. I want to be right and make money. Now, if I have a speculative play like LinkedIn, geez, I wish I would. I'm so bearish on that stock. I wish I would have bought puts before the earnings tonight, right? I wish I would have called it. We'd all be rich now. But my thing is, like, if you wanted to speculate on a stock like that, like, I think Tesla's going down below 100. I'm really strong on Tesla short. So, you know, the puts, the in the money puts are crazy. Even the out of money puts, the premiums are crazy. But once in a while, what I'll do is I'll look at the $100 puts, for whenever, I don't know, next January, whatever. I don't know what they are. They're probably too expensive anyways. I'll tell you what they are. I'll look it up right now, as a matter of fact. If you guys give me a minute. I mean, so, some stocks it's really hard to do because premiums are just so ridiculous. Like Tesla. Okay, so let's look at Tesla. Closed today at 175. If I want to go and play leaps on it, go to January 2017, not 70, obviously. The 180 puts are 2850. Actually not horrible. But if I go down to 125, oh wait, that was calls. Sorry. If I go down to 125, the 125 puts on Tesla for January 2017 are $15.55. That's a tough nut to swallow, right? Now I need to move to 110 to break even. The stock is 175. It's a 65. My premium is insane. So then what I can do is I can look at a spread, right? So let's say I want to look at let's see what the 150 puts are. Okay, this isn't bad. So if I want to play the 150, 125 spread, the 150s are 25 for next January. The 120s are 1550. So my net debit is $9.50. My possible return is $25. If Tesla goes 125 or below at expiration, January 2017, I stand to make 2.5 times my money. So in that case, I like, now you could look for a cheaper spread too. So let's say you wanted to play, and this might, like the 125 puts 1550, and you wanted to buy sell the 110s at $11. So now your cost is what is that? $4. So 450. 450, and your potential return is 15. So it's better than 3-1. Of course, you need the stock to fall 65 points by January 2017. Okay? So there are strategies that you can use. The hundreds aren't $37. The $100 puts for next, no, they're like, what are they? They're $8.25. So you would need to move down to 92. But I'll preface it by saying, if you did this trade, that kind of trade, and Tesla moved down 30 points tomorrow, or after earnings, those puts are probably going to be $13, $14. So you're going to make money on them. It's just, ultimately, if you held them all the way through expiration, you would need the stock to be under $92 to make money. So, that's a tough trade. It's really tough. But having said that, you looked at LinkedIn today, pre pre earnings, and you bought the 195 puts that expire tomorrow at 1325, hell, you would have made quite a you would have made they're worth $60 or something, right? It wasn't like 135 after hours. If you would have bought the 150s that expire tomorrow, you could have paid 42 cents. Now, I wish I was that smart, you know, but, somebody probably bought them. They traded 2000 today. So somebody was smarter than me because they got on those, they got, what, 10, 20, 3,000%, something like that, maybe more, maybe 4,000%. It's not a bad return. Um, so, so anyway, so Judy, I hope that answers your question a little convolutedly, but it's not, that's the hard job. I mean, that's, I always, pound my head against the mirror trying to figure out which one makes sense. And sometimes your timing is off and you lose. And even though, you end up being right, you know, I mean, it happens, and you got to be ready for that. Or prepared. You may, sometimes you do it and then you know what, you roll it over to the next month because it didn't work this month. And then, okay, you roll it over, and hopefully you catch it then. That's always the downside of playing straight options, playing calls and puts. But sometimes I like spreads because the only thing bad about a spread, obviously, it's not bad, but it limits your upside, right? You can only make 2.5 times your money, 100% on your money, whatever it is. You can't make, you know, whatever. If you move point for point, you're not going to make point for point, right? If you bought, you know, 10 LinkedIn puts today, the 195s, you made yourself 50 grand after hours. Of course, you would have risked $13,000 to make that trade. So yeah, you would have made 4 to 1, but you needed the stock to drop $55. That's that's a big move. I mean, people don't make those kind of predictions often. My Apple call to $44 is a pretty ginormous call. And there's an opportunity there to make some real money if I'm right. If I'm wrong, okay, you limit your losses by using options. Any other questions?
Anybody has any questions about the professional trader program?
Yeah.
Be glad to answer.
Yeah, if you're interested in the personal trading program, which you all should be, email support@affinitytrading.com, and Mike will get ready, or Mike at affinitytrading.com, and Mike will hook you up. And Mike will hook you up. If you want to email me, I have an affinity email, but it's easier to reach me at mwparness@gmail.com. Feel free to email me any questions, thoughts, comments, testimonials, hate mail, whatever you want. You guys also should know that my new book is out, The Art of Trend Trading, and it's for sale on Amazon. You should all pick up a copy. $20. You won't spend a better $20. I think it's my best book to date. And yeah, we're here to help you. And some of you I know don't have the resources to have buy do a $10,000 education / trader package. So give us an email and say this is I don't have this, but I want some help, and here's what I have, and we'll figure out somehow to, we'll figure out a program that
We
works
do
for
have a
you.
payment plan, so yes, we do.
Yeah. Yeah, Mike just posted the link to my book. Thank you, Michael. So,
That's
yeah,
the application. If anybody
we're going to
interested,
be
you can put
doing,
in the comment section. I'd be interested in a payment call. We'd be glad to have you.
um, also, we're going to be doing more free classes. We should be doing, pretty much one a week, one every 2 weeks, starting next week. We probably do another class. We'll see where the market is, and I'll do a class based on how the market's trading then. Again, keep in mind tomorrow, I want you guys to be careful because the market's going to be pretty tricky tomorrow. We have the employment numbers. We should get a really big move off those numbers. If the numbers are better than expected, then we should get a pretty big gap down. If they're worse than expected, we may gap up, but I think it's a fade ultimately. So we'll see. All right, everybody. Peace out. And I look forward to seeing you guys in the chat room.
Good night, everybody. Thank you so much for spending your Thursday evening with us. I hope you found this educational.